Hello and welcome. Thank you for joining us for our Crow after webinar Q&A from the session on Are You Ready for Pillar 2? We're going to turn now to the team to address some of the questions that came in from our live attendees during that event. Team, over to you.
All right. Thanks, Matthew, and thanks everyone for joining us here on the after party. We wanted to take a minute here to go through some of the more frequently asked questions that we saw come through. And so we'll just jump right in. John, maybe you can take this first one. If there's multiple jurisdictions that have a UTPR, how is the top-up tax allocated in that situation?
Sure. So if there's more than one jurisdiction that has a UTPR, right, so it's actually going to be creating the tax based on another jurisdiction's rate being below the 15% ETR. That's going to be allocated between those jurisdictions based on their substance. So it's going to look to the employees and the amount of tangible assets that are in the various jurisdictions. And so basically it's going to be up to the UPE to determine what the allocation is that's going to be allocated to each of those jurisdictions.
Great. Thank you. Obviously, it's not going to be a simple calculation with all the moving parts here. I guess another question here, Matt, maybe you can take this one. Can you clarify a bit more on the permanent safe harbor versus the transitional safe harbor rules?
So within the model rules, the OECD acknowledged kind of there would ultimately be a safe harbor, I guess, system within the overall globe ETR regime. It's really kind of just a framework only at this point. It does speak to kind of a de minimis safe harbor, an ETR safe harbor, and kind of a routine profits aspect. But it's like I said, it's just really a framework. What we focused on, and what I think we see a lot of our clients focused on, is the temporary transitional country by country safe harbor. Those rules point more specifically to the country by country report, information in that report, and information used to prepare that report. So while we, again, ultimately expect there to be more than just a framework for permanent safe harbor rules, the focus today is on the country by country safe harbor regime.
Great. Thanks, Matt. One thing that came up a bit, and I know we did talk about this during the webinar and we had some slides on it, but I think we've seen the question and it's obviously an important question in the context of Pillar 2. And so maybe, John, if you don't mind, can you talk a little bit more or clarify a bit on how covered taxes is defined within the context of the top-up tax calculation?
Sure. So your covered taxes are basically determined by starting with your current tax expense in your current financial accounting net income or loss. And then you have to make some adjustments from that expense, for example, for tax credits or other disallowances. You got to take into account your tax credits. If those are not refundable or transferable credits, they're going to be a reduction in your effective tax rate. And then you're going to add in your deferred tax expense, net of your deferred tax assets. And so any of the assets are going to be reset to a rate of 15%. If you've got pre-Pillar 2 NOLs, there's some adjustments that you're going to have to take into account there. And then you're going to have to look ultimately at your DTLs that may not reverse over a period of 5 years. And those are going to be recast to zero. And then finally, if there's taxes that are in your current expense that aren't on income that's included in your globe income calculation, then you're also going to have to pull those taxes out.
Great. Thanks. Soumya, I want to give you a chance to have fun here at the party with us as well. And so maybe you can take this next one that we saw come up. So what incentives are we seeing that countries are providing around Pillar 2?
I think that's a very good question. And, for those who do not know much about me, I come from Singapore, and Singapore is one of the big jurisdictions that used to offer a ton of incentives to attract foreign direct investments. Matt also mentioned Switzerland in his presentation. And I think what Pillar 2 has really done is to get governments away from offering tax incentives because of the need to meet that minimum 15%. And so, Matt mentioned Switzerland is going to be doing the QDMTT. Singapore is going to adopt IIR and domestic top-up tax. And what they are planning to bring in place is actually refundable tax credits, subsidies, and other forms of credits and incentives, which would go above the line to get to continue to attract the foreign direct investments. And that is something that taxpayers also have to be mindful of.
Thanks for that. I think lastly, one of the things that, we saw in the webinar with the responses that came through was just, a lot of people are still trying to figure this out and figure out where to start and scoping this out. And does it impact us? Does it not impact us? And so, from a practical perspective, maybe Matt and John, if you could talk through a little bit of what are the next steps that companies should be considering right now?
For me, it starts with figuring out the MNE group. As we mentioned, a group is a collection of entities that are related through ownership or control and are included in the consolidated financial statements of a ultimate parent entity of the group. And if consolidated financial statements aren't prepared, as we mentioned, it's okay, what if they were? So I think starting with figuring out what is the group, what are the entities in the group, that for me would be step one.
I agree with that, Matt. And then after that, it's just really digging into the transitional safe harbor rules. Those are meant to sort of take the burden off taxpayers, at least for the first few years, whether it's the de minimis rule or the substance-based exclusion rule, or simply the effective tax rate rule. I mean, that's a pretty straightforward calculation. And if you're not taking advantage of that sort of in year one, you're going to be barred from doing that going forward. So I would say get your MNE group in place. If you're over 750 million, go through each of your jurisdictions, use 2023 data if you have it, and then from there go, okay, what are the things I need to account for in 2024 that are going to be different in 2023? So at least you've got some baseline to work with.
Thanks, Matt and John. Certainly there's a lot for companies to be thinking through here, modeling, but I think those are really helpful suggestions for the next step for those struggling to figure out where to start. If you have any questions or there's any way we can help you through the process as you're navigating all of this, please don't hesitate to let us know. Our contact information's on the screen. We're here to help you in any way possible. Thanks.